Welcome to the deep dive video update, where I go through charts that I look at every day, but maybe I don't use in every daily video. So I have to look deeper to see if we're getting any clues from those charts. And I also have some additional charts that are unique just to this video. This is being prepared for Monday, April 14th. Well, it was a very wild week. We saw big up moves, some big down moves, a lot of emotion going on. The VIX at very high levels. In fact, we are going up with the 50 period moving average of the VIX, but we're still in that lower band. However, since we've been going up pretty much since the beginning of 2025, you could take that as more negative. If we shift over and keep going down, it's very likely that we're going to go above this 20 level and get into a higher range similar to what we saw in 2022. When the market's going down, the VIX goes into a higher range. When the market's going up, it drops down into a lower range. Now, I did show this chart a number of different times, but not over the last couple of days because the VIX has actually been coming down a little bit and it's been just skyrocketing up. We got above 50 there for a while, then we're dropping back down. The RSI that I use on the VIX measures what's the momentum, what's the speed that's going on here. And we got above the 70 level all the way up to 90 before dropping back. But right now, it's a little more calm, even though we're getting a very high reading at 37.56 right now. Then this is a VIX study and a correlation with the S&P 500. Even with all the craziness going on here with the VIX, this correlation has really not changed all that much. It's really come down. We're not getting any insight from that. As we've been really going down, we're seeing that the VIX is going up faster than the VVIX, which is the volatility of the VIX. That just shows that the market is under pressure. Typically, in a general sense, when this is going up, that's negative. When this is going down, that's positive. Then the skew index, where the VIX uses at the money options to be calculated, the skew index uses out of the money options. So it's kind of a bit of a variation of the VIX. We pay attention to this when it goes up into this red area. It finally dropped down out of here and it's been below that red area. So I look at it, but I don't really use this to get any insight from when we're down out of that red area. Then we look at the volatility of stocks and do it with a ratio with the volatility of bonds, and both have been very volatile lately. We're just kind of going all over the place here. I mainly follow the red line, and as this is going up, that means that volatility is picking up, which is typically negative. And we look at the large cap growth ETF. This is not looking very good right now. We're seeing the moving averages coming down. Prices is below all the moving averages. This had been one of the leading areas of the market when we were going up. We hit that high in the middle of February and been having trouble ever since then. So I haven't been showing this because growth has been underperforming value. And even though the large caps have been under pressure, the small caps have been even under more pressure. And that's why we're seeing this ratio going up because the small caps are just not doing very well. Then we look for just informational purposes. Where are we in reference to the October 2022 low? We're up 53.48%. Where are we in reference to the October 2023 low? We're up 30.69% as of Friday's close. Then this is almost unusable this week. My goodness. There was so much movement in the market, so much gyration. You can see earlier in the week it was all red. Those are negative alerts. Then we had that big update on Wednesday and we saw some improvements taking place. Then we had a give back day on Thursday and then we had a fairly positive day on Friday. And you can see it. I mean, all you can do is see color here. You can't really interpret these anyway. I do break these down every day and go through them in the daily video update. Then I look at six indexes, the S&P, the Dow, the NASDAQ 100, the mid caps and the small caps, and they're ranked on a score of 0 to 100. The higher the score, the better looking the chart. Now, none of the charts are looking very good right now, but there's still charts that are holding up better than others. And yet again this week, we have the Dow coming in first place at 54. Now, 54, it's just a little tilt towards the positive side. When this is really strong, it'll be in the high 80s to low 90s. So coming in with a score of 54 is not all that great, but it's the best looking index right now. Then in second place is the S&P at a distant second at 38. It's a little more balanced because it has growth and value in it. So everything that's in the Nasdaq 100 is also in the S&P 500 plus a whole lot of other things. So it may lag behind when we're really going up, but it might hold up a little better when we're going down. That's why it's in second place. Then in third place are the QQQs coming in at 32.7. That's pure growth right there. Then we have the NASDAQ itself coming in next at 27.5. Still not very good scores here. The mid caps coming in at 13.9. They're under a lot of weakness. And I don't know if you'd call this single digits or double digits because of the decimal, but small caps are still coming in under 10 at 6.9 here. Not looking good from a technical analysis perspective. Then I have a short-term rainbow going from 10 periods to 50 periods with a simple moving average. You can see we're just coming down here and the rainbow is just falling over. It's looking more like a waterfall than a rainbow right now as the short-term trend is clearly negative. Then I don't show this chart right now because the 20 period moving average is what I use to determine the short-term trend. Even with the bounce up, even with the greater than 5% gain of what we saw this week, we're still well below the 20 period moving average. Intermediate term, another rainbow going from 50 periods up to 100 periods with a simple moving average. We're below that, and you can see the lines are jumbling up here and now starting to spread out and go down. This is clearly showing that the intermediate term trend is negative. And then I look at the 50 period moving average, but I haven't been showing that since we're so far below it. And the same thing with the 100 period moving average. We have a long ways to go just to get back to those moving averages. The Bollinger Bands, which I showed a week ago, and we were seeing something very interesting last week. We were seeing an extreme negative reading, not only on the daily chart, but also on the weekly chart. Excuse me. Well, we worked that off on both the weekly chart, which I don't have here, and the daily chart, because that doesn't last for very long. We closed outside the lower Bollinger Band, below it. And that means that we're really extreme at that point, especially when you see it on the daily chart and the weekly chart at the same time. Well, we bounced back up enough and see, even though we've been going up, we had an up week, the Bollinger Band continues to go down. So that's the adjustment. The Bollinger Band has to go down, price has to go up, or the combination of the two works off this extreme negative reading. Then we have the Landry light. For some reason, I always want to call it laundry. The laundry light, this doesn't really seem to be giving us a lot of additional information that we don't already know. These red bars just show that it's a negative trend. And the longer it goes, the longer these bars are. And it just keeps going on and on and on. Then we also have a thing called the proper order. That's a very similar thing to what we just looked at. Although everything here is blue, if it's going up, that's positive. If it's going down, that's negative. It's the background, it's red. So this also shows that we are clearly in a downtrend here. The CMB composite, which I did use earlier on because we were getting an extreme negative reading, well, we've been able to work that off right now. So really no additional insight there. Then a thing called the bow tie, which takes a 10 period simple moving average. That's in green. And we're getting back up there, but we'll see if that's going to end up providing some kind of overhead resistance. And then a 20 and 30 period exponential moving average. Now, a simple moving average treats all 10 periods the same, but this green one. An exponential moving average weights it closer to current price, so it moves quicker. And this gives us an idea of what the trend is. And since we're so far below it, except for the green line here, there's really been no need to show this because we're seeing this in other charts. Then you have the Connors RSI, which works just like a regular RSI. We're trying to determine extreme positive or negative readings. It gyrates around a lot on a daily basis, but we don't get extreme positive or negative readings that often. We did get one last week, but we've since settled down and we're really not seeing anything extreme right now. And then Landry also has a volatility measure, which is kind of like the VIX, and this is applied just to the S&P. Just shows that volatility is still really high, something that we're already learning from the VIX itself. Then I stopped showing this because this is an intraday measure of the all-time high set back in February, the low that was set here in April, but this measures on an intraday basis. Now, the definition of a bear market is the close that we set in February, and then the close, however low that is, once it gets beyond 20% on a closing basis, that's a bear market. We never got there on a closing basis. We did get there on an intraday basis, and then we came up off of that, and we've been trying to bounce up since then. So there is some improvement according to statistical analysis of a bear market versus a correction versus a bull market. A mini rainbow, which is a 20 period simple moving average of the open, high, low, close. We're far below the lines, and the lines are going down. So this chart hasn't really been helping us. We look at the S&P 500 and compare it with the S&P 100. Even though on a ratio basis, the S&P 100 is underperforming, we're not really seeing anything all out of line here with this. Then we look at the 10-day average of the highs and lows for the S&P, and this is dropping below 50 and declining. When we really pay attention to this is when we get down below this 10 level, if we even reach that point. The Pring Bottom Fisher, which a week ago I was showing in the regular videos because it was showing that the black line was above the red line. That's a buy signal. Well, since that time, this has crossed back below the red line, so that buy signal went away and obviously didn't really prove to be much good because it gave the buy signal before we really tanked. Then long-term rainbow going from 50 periods up to 250 periods with a simple moving average. We're even below all the lines here, and the top lines are starting to roll over. This is also showing that the long-term trend is very vulnerable. This I do look at every day, but we get so few signals with it. It's called the Special K. It's a very long-term oscillator. And we're turning more negative. We're turning down on the weekly chart, but we haven't crossed negative yet, where we have crossed negative here, and that is longer-term negative. And we look at the weekly chart of the S&P on top, a weekly chart of the German DAX, and we see that the correlation is pretty much neutral now. Up until a few weeks ago, the German market was really outperforming the U.S. market. The U.S. market was going down as the German market was going up. But over the last week or so, everybody's freaked out altogether, and everything's been going down, and that's been working this correlation back to pretty much a neutral. Then we look at an Ichimoku cloud, and we're far away from the cloud. It's clearly negative. We have the green line that had been coming down, although it's improving. We still have the blue line below the red line. That's negative. It's positive when the blue line's above the red line, and we're way beneath the whole Ichimoku cloud, and now it's starting to turn red. So this chart is not looking very good right now on a daily basis. And really all this is are current moving averages that are shifted forward, and these clouds, which are heavily used mainly in Forex trading, well, it can be useful here too. And we're not near any of the clouds to either offer support or resistance. In fact, it would be resistance if we started going up from here. Then looking at the VIXen, which is the NASDAQ 100 version of the VIX, volatility has really been spiking there, both with the bar chart and with the line chart down below. And this is a weekly chart of the QQQs, which is the ETF for the NASDAQ 100. We had that real big down week last week, and we started off bad, but then we ended up having a pretty good up week here. So that's why we see a different color candle. The Qs, which are the ETF for the NASDAQ 100, still below all the moving averages. We see that the 50-period moving average is getting really close to the 200-period moving average. And that's what we're seeing on the NASDAQ 100 too. It's about getting ready to give us a death cross. Where we go, when we're positive, that's a golden cross. When it crosses down below, that's called a death cross. And we just see all the lines rolling over and moving down. Just not looking positive right now. And we're close with the S&P too. But the Dow is still hanging in there. However, the NASDAQ, the mid caps and the small caps and some other charts, they're turning negative. Where some of the more value-oriented indexes, they're holding up for right now, but close to going negative. And we look at the S&P on top. We look at the QQQs, which is growth, and the diamonds, which is considered to be value. and then do a correlation between the two here. And it's coming down, not as strong as it had been before. It's getting closer to that neutral area. We look at the Dow and then the transports, and even though the Dow's been going down, the transports, which is red, they've been going down even more. They're just not a really good area right now. And the bank ETF, we want to keep an eye on the financial sector. We're still well below the 200-day moving average. We're coming down with the 50-period moving average, and we could be getting ready to generate a death cross there. And then we look at the regional banks. These are the smaller banks, and we do a ratio of that to the financial sector. Now, the last couple of weeks, I was pointing out positive things in this chart, that the market was really going down, but this ratio is holding up better. Now we're just seeing the opposite. It's really coming down. This means that the regional banks are underperforming in the financial sector. Then some long-term rate of change charts. This goes back 250 periods, showing that we're coming right down to this zero level, but we're just barely above it right now. We're hanging on to being long-term positive, and we're just barely above zero with this other chart going all the way back to 1980. And we're seeing kind of two stories being played out. When I did this video a week ago, I was remarking that no, inflation may not be a problem because this ratio is going down. Because that's what we're trying to see here. What is the context? When this ratio is going down, that means that the market's not really concerned about interest rates and they're not really concerned about inflation. Well, for some reason, bonds have just got hit this past week. We went up 0.5% in 1 week. That's a huge move for the 10-year bond. And there's speculation that maybe China's doing some selling, which could push the price of bonds down and interest rates up. There's also some speculation that maybe some hedge fund in Japan ran into trouble. We don't really know these things. It'll be down the road when we find out these things, but we're trying to figure it out right now, not down the road and then go, oh, yeah, that's what was going on there. We want to know what the context is right now because we saw an exact reversal this week. We were coming down with this ratio, and then bonds started getting hit, and this ratio really started to go back up. So we'll see what happens in the upcoming week. We're seeing a very similar thing here with tips. These change for inflation, they adjust. And then we compare them to 3 to 7-year bonds. Now, this is still looking better. This ratio is still continuing to drop off, which means there's not necessarily inflation worries in the market, according to this chart. Then we look at tips in 7 to 10-year treasury bonds. We're also still staying down here, but it's very choppy. We're going up, then we're going down, then we're going up, and we're kind of all over the place here. This is still suggesting that inflation is not a concern as far as the bond market is concerned itself. They're concerned about a billion other things, but inflation is kind of further down on the list. And then we look at the long-term bond, which is in blue, and the S&P, which is in red. We see that their longer-term correlation is starting to get a little bit stronger, but kind of working its way back to this neutral area. Their shorter-term correlation is also pretty much in the neutral area and trying to get a little bit stronger. We do that same thing with the Qs to the long-term bond, and that's coming back up and getting more neutral, where they had been having a tendency to go in opposite directions, where they were going in the same direction before, which is down, okay? And then we look at the 10-year yield and subtract the German 10-year yield. That gives us a positive answer. And then we plot the US dollar index in the middle, and then we can see that there's a pretty high correlation. So when you look at things this way, and the dollar's been getting hit a lot too. It's really coming down and dropping underneath 100. And interest rates have really been going back up. But we see that the correlation here is not getting all that out of hand right now. That just means that despite any craziness going on, the interaction between interest rates and currencies, because they might be selling the dollar, meaning China, they might be pounding the dollar down below 100, but at least there's no real disconnect between what we're seeing in these top two charts. Okay, then we look at the 10-year yield, which was coming down. Now it's starting to go back up. Sometimes when this spikes and comes down, that can give support to stocks, but it's been all over the place lately. And we just want to keep an eye on this. The 10 to the 2-year yield curve, not inverted right now, still looking pretty normal, which is what you would expect. Because the reason I'm watching that is because of this chart. We went inverted with the 10 to the 3-month yield curve. Now we're back to no longer being inverted. And now we kind of start the countdown to say, okay, because when this becomes inverted and then no longer is inverted, that's when you say, okay, how much longer until we go into a recession? But we're not seeing that in this chart. And most people pay attention to the 10 to the 2. I also pay attention to the 10 to the 3 month. That's where we're getting some signals right now just to watch for things. And then we look at European stocks and compare them to American bonds, really breaking down, but saw a nice little bounce back up with this ratio. And then we look at the percent of stocks in the S&P above their 200-day simple moving average. This is like an oscillator. We look for an extreme positive or negative reading. Not getting that right now, but we are below 50. We came all the way down to 17.5 and we are bouncing back up. But this really isn't telling us much because we like to see an extreme positive or negative reading with this chart. We do that same basic thing where we actually went extreme negative with those stocks in the S&P above their 50-day moving average. And I was showing this chart then, and we actually are getting a little bit of a bounce up there. We went extreme negative with the mid caps, getting a little bit of a bounce there. And I was showing this chart, and the same thing with the small caps. They're just barely getting out of this extreme negative territory here. So I didn't show those because in the videos that I'm showing them here because I usually show them in this video. But if things start to act really weird again, I'll certainly put these over into the daily video. So thank you. I hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.